Most people have not invested in a real estate syndication yet for one simple reason. They overcomplicate the entire process in their head. They think you need to be super wealthy, have insider connections, or go through a complicated process to even get started. But the fact is, once you actually learn the process step by step, it's actually pretty straightforward. So in this video, I'm going to walk you through every single step of how to invest in a multifamily syndication. So let's get right into it. First, let's start with what is a real estate syndication? Well, basically, a syndication is a group investment in real estate. You have an operator, also called a sponsor, who finds the deal, structures it, and executes the business plan. This sponsor manages the entire investment from start to finish. And then you have a group of passive investors who pool their capital together to fund it. As a passive investor, you put your money in, you collect distributions as the property generates income, and you get your share of the profits when the asset eventually sells. But you are not managing any contractors, you are not dealing with any tenants, or fixing any leaky toilets. You are a limited partner, aka a hands-off partner. Your job starts and ends with picking the right deal and the right operator to invest with. The reason people invest in syndications comes down to time and expertise. The thing is, most individual investors could never go out and buy a 150 unit apartment complex on their own. Financially would be the first reason, but also most busy professionals have no idea how to analyze multifamily properties, oversee contractors, or how to manage hundreds of tenants in a building. And honestly, most people would probably not want to deal with any of that. So through a syndication, investors can own a small piece of the property without any of the headaches. With this structure, you get all the benefits that come with real estate, but you can still focus on your career and spending time with your family. Okay, so let's say you want to invest in a real estate syndication. Here's what most people skip. Before you start researching operators or reviewing investment opportunities, you need to get clear on your goals. Are you investing to supplement your current income, or for long-term appreciation? For example, if you wanted to start receiving quarterly distributions on your invested capital right away, a multifamily development is probably not the right fit for you. Or maybe you don't need the distributions right now and you are comfortable waiting 3 to 5 years down the road before you see a big return. In that case, a development project would be a good choice for you. Ask yourself, how long can I realistically lock up my capital? Most syndications have a hold period between 3 and 7 years. And I want to be direct about something. Syndications are illiquid investments. So once you put your money in, it's in. You need to know what you can commit before you fall in love with a deal. You should not be investing money that you might need in the immediate future. Most syndications require a minimum of $50,000 to participate. So you need to make sure that you and your family are comfortable with that amount. But I also want to be real with you. Now is also the time to consider the downside. If you lost $50,000 in a real estate syndication, would your family still be okay? All investing comes with risk. And now is also the time to chat with your CPA. Ask how investing in a real estate syndication will affect you and your family's unique tax situation. You'll also want to figure out whether or not you're an accredited investor. Some syndications are open to only accredited investors under SEC regulations. Generally, that means an annual income of at least $200,000 or $300,000 combined with a spouse, or a net worth of $1 million, not counting your primary residence. This matters because it determines which deals you're even allowed to participate in. So figure out where you stand before you start reaching out to anyone. Okay, so now that you've done that internal work and hopefully thought about your investing goals, it's time to start researching operators. The sponsor or developer running the investment is by far the most important factor when evaluating a syndication. You are betting on their judgment, their experience, and their integrity. A great deal with a bad operator will not turn out well for you. So what are you actually looking for? Track record first. Has this operator had successful past deals? Do they have experience in that asset class and strategy? Are they laser focused on one strategy, or do they invest in multiple things like self-storage, mobile home parks, etc., all at once? Commercial real estate is a pretty small world, so ask around about these companies. Look for reviews on their Google business page, and better yet, one of my favorite resources I tell investors to look at are reviews on investclearly.com. This is a site where only verified investors can leave reviews on the sponsors they have invested with. You can also ask about when something went wrong or something unexpected happened on a past deal. If anyone tells you nothing has went wrong on a past deal, they are absolutely lying to you. What you really want to know is what happened when things got hard. Did they communicate that to investors? Did they have a plan? And how did they solve the issue? That's the real test. A good operator is upfront about what could go wrong and not just about what they're hoping goes right. Okay, so after researching different companies to invest with, now you should consider where you want to invest. Where the deal is located matters a lot. Sunbelt markets like Texas, Florida, and Carolinas have all seen strong population growth and faster appreciation over the years. But they also have the bigger swings when the market turns, and we've seen a lot of that play out recently. Midwest markets tend to be slower and steadier, less explosive upside, but more resilient when the market shifts. You also need to do your own research and find markets that are business and landlord friendly, as this can have a huge impact to the operations of the property you're investing in. At the end of the day, everything depends on your risk tolerance. Okay, so once you've identified operators you trust and you have a sense of the markets you're interested in, the next step is simple. Sign up or register on the investor list with the different companies you want to work with. Usually, you can just go to their website, find the investor page, and sign up with some basic information. That's it. This is how deal opportunities get sent to you. When a sponsor has a new investment opportunity, they typically email it out to the investor list. So make sure you have these companies added to your contact list so the email accidentally doesn't go to spam and you don't see it. Now, at some point, an investment opportunity is going to land in your inbox. This is where your real due diligence begins. And here's where I see a lot of new investors get it wrong. They go straight to the projected returns, they see a high IRR on a one-page document, and they're ready to wire over their money. This is not how you evaluate a deal. Read everything they send to you. Understand the business plan. Is this a value add or ground up development? What assumptions is the operator using to get those projected returns? The assumptions drive everything. Things like rent growth projections, occupancy targets, the debt structure, and exit cap rate. You can also look to see if the sponsor did a stress test on the deal. Always look for signs that the sponsor is trying to underpromise and overdeliver. And most operators also host a webinar where they'll walk through the deal live and answer any questions. If you're serious about investing, you should attend that meeting. Now is your time to ask questions about the deal, the returns, and how the sponsor is protecting your downside. A good operator has thought through all that. No question is a dumb question here. Okay, so assuming you like the deal and you want to move forward, you will now make a formal commitment, usually by creating an account on the operator's investor portal and entering how much you want to invest. Treat this like a real commitment, even if it's just technically soft at first. The sponsor uses these commitments to gauge how much capital they have left to raise. So the sooner you reserve your spot, the better. Sometimes these investment opportunities can fill up in a few short weeks. After you have made your formal commitment, now is the time to sign some documents. And no, it honestly doesn't take that long. You'll sign 3 main agreements. First is the PPM, or the Private Placement Memorandum. This is the legal disclosure that outlines everything about the offering. Second is the subscription agreement. This is your formal commitment to invest. And third is the operating agreement, which governs how the LLC is structured and how decisions get made. Feel free to have an attorney review these, especially on your first deal. A real estate attorney who has worked with syndications before can walk through them in a couple hours. Small cost, but it's good to get a second opinion. Assuming you're good with everything in these documents, you will usually sign everything electronically. And the very last step is wiring in your funds. So once your wire clears and your documents are signed, that's it. You are officially in the deal and your hard work is done. From here, you sit back, receive email updates from the sponsor, and share in the profits from the deal. Honestly, the first deal you invest in will be the most difficult just because everything is a new process to you. But each investment after this gets much easier. So here's the big takeaway. The process of investing in a real estate syndication is nearly not as complicated as it looks from the outside. Investors should clarify their goals, find operators they trust, and invest in strong deals in great markets. If you've been thinking about getting into your first real estate syndication, I hope this clarifies the entire process of getting started for you. If you want to learn more about real estate syndications, I created a free 7-day passive real estate investing 101 email course. You can find it at goodindevelopment.com/course, and I'll leave a link in the description of this video. Thanks for watching, and I'll see you in the next one.